Ladies and gentlemen, welcome. We are live from Nashville. We're here at the MBA Annual. We're on the floor. We're at the Insellerate booth 1111. Easy to remember that, but I have a very special guest. We are kicking off the MBA. Jim, please introduce yourself. I'm so excited that you could join our podcast.
Well, ladies and gentlemen, good morning from Nashville. I'm Jim Deitch. I am founder and CEO of Teraverde. We work on both the digital domain and digital analytics, as well as capital markets and LOS activities. So, Michael, pleasure to be here. Thank you for having me.
Well, it is great to have you, Jim. I've known you for a long time. You have a wealth of knowledge and expertise. Let's kind of go through yesterday. Chief economist of the MBA kind of gave an update of the industry. Talk to me a little bit about his observations, some of the things he shared, your take on it, and let's talk about the cost to originate, because that's one of those things that is top of mind for everybody here.
It is top of mind, and really three takeaways from yesterday's economic update from Mike Frattitoni and his team. The first was Mike indicated we're, if not in a recession, we'll be in a recession. I don't think that's really news, but the comment that really got me in some of the discussion was it's probably not going to be as soft a landing as the Federal Reserve would like or the politicians would like. So one is it's going to be tough on the employment side, and we got to keep our eyes on credit performance of all the mortgage loans that we have. So that's item number one here. Item number two is the level of production forecast. Mike reduced it to about $1.5 trillion in purchase business and just over $0.5 trillion in terms of refinance. The refinance number, I think, by its nature, is very heavily rate dependent. There was a large discussion on the cost to originate, and a couple of takeaways from that. First, we're at $11,000, and in talking to some of my friends in the industry, that's the average of the MBA lenders that are in that 330 or so lenders that are contributing to the mortgage profitability report. But some of the accountants I've talked to, the CPAs, say that 11,000 may be on the low side for some of their clients, particularly in California, some of the coast areas where costs are pretty high. The amazing thing I took away from all that was productivity. Productivity in the industry has been falling not just for the last couple of years, but actually 20 years. The number of underwrites per underwriter per month has fallen from about 113 in 2003 down to approximately 25, 26. And that's just hard to understand how it takes so long to underwrite a loan. So those are some of the takeaways. And Mike, that's an introduction. So go where you want to go.
Well, and that some of those numbers are just shocking. And so one of the questions I want to ask, obviously, FinTech, we're here at the conference, there's all of these tech providers. Technology has continued to get better. So why is the cost to originate climbing? Is it a lack of adoption? Is it a lack of, it's the wrong technology being built? Give me some of your insights on that.
Well, interestingly, the cost to originate does not vary greatly by the tech stack that's being used. And that's kind of a shock in some respects. Right. You would think that a tech stack would have a material impact. There are some differences, but whether it's 9,500 or 13,500, it's still $5,000 to $7,000 higher than it likely needs to be.
Right.
The other area that is just a shock is if you look at the cost composition that the MBA has put out, about 3% of the cost to originate is technology, and 68% is labor costs, compensation costs. And of that 68%, almost half of it is back office labor. So we're spending roughly, if you do the math, 68% of 11,000 is about $7,500, and half of $7,500 is $3,750. So we're spending $3,800 on back office costs. Put that to an hours spent in preparing a stack of paper for closing.
Right.
It's hard to believe. It's just hard to believe.
It really is. And even though there's a lot of great office technology and everything like that, I think one of the things, and I've talked about this before, Jonathan Kors used to say this. In the mortgage industry, we have a huge propensity for using human spackle. When volumes are up, we throw bodies at it. When volumes are down, we start shedding those people. And I'm still amazed that with all of the technology, with all of the incredibly bright people here in this room, we can't do something to start lowering that cost to originate.
Well, the other interesting thing from Jonathan, and I've known him a long time, he told me that with respect to his LOS stack, in his view, lenders were getting about 10 to 15% of the native automation functionality that was built in.
Okay.
And a lot of that is people still fall back on the manual processes and just using people instead of the hard type. I mean, it's hard. Technology's hard. It's hard
Right.
to integrate.
Yep.
It's hard to make it work. So it's sometimes easier when you're really busy to say, let's just put some people at it. And I'm going to
And
slow down.
they underwrite the files, and they're doing them by hand, and they're doing their own thing. And yeah, isn't that amazing? What are some of the other things? What are you excited about in 2023? It's not all doom and gloom.
No.
It's going to be $2 trillion. From historically looking at, you and I can take a look at it historically and say, still a lot of loans being closed. What are some of the things you see, or what are some of the bright spots on the horizon in 2023?
Yeah, well, that's a great question. And there are a lot of bright spots, and one of them is actually some of the. I looked through all the data on the largest lenders, and I'm going to publish a piece probably later this week.
Okay.
It looks at the lenders by purchase volume. So when you stack them by total originations, you get one stack. When you stack them by purchase volume, you get a completely different stack.
Gotcha.
And if you take out some of the spectacular kind of either wind downs or reductions, it's going to be a whole new ballgame. So that's item number one. Item number two is distributed retail still has the most opportunity in terms of helping clients understand how you can still get a mortgage and why real estate's still a good investment. Right. Was talking with Dave Stevens, and his advice to originators is sell with facts. Look at the long-term accretion of equity that comes from home ownership versus rent. And his comment, which is really great advice, it says, own your home or rent your mortgage, not the other way around. So if you own the home, you can always refinance when rates fall. Mike Frattoni said, look, we'll see rates in the mid-5s by the end of 23. So that is going to be, I think, a real positive as we get near the end of 23 to have the chance for the cost of home ownership to go down. So that's number one. Number two is, we've done a lot of research with lenders, and here's a shock to me. The productivity of the most productive people, particularly in the back shop, compared with the least productive people in the back shop, varies by a factor of 4, 5, or 6.
Wow.
It's not 1 or 2. It's some people are twice as productive as average, and some people are 50% as productive as the company average. Some are 25% as productive as the company average. And people go, Jim, why does that matter? Well, if you're paying an underwriter $100,000 and that underwriter does twice as much as the average person, your cost per underwriter is significantly lower. If that underwriter's only half as productive as average, that means your cost to underwrite compared to the most productive is 4 times higher. And I don't know about you, but that's a lot of money.
It is.
You cannot afford it. That propagates through underwrite, processor, closer, back shop, service. That variability there is really spawned a concept that maybe we can talk a little bit about top tier.
Go ahead, Jim. Let's talk about that, because I think top tier is going to be critical as lenders look to go forward and say, how do I have a sustainable lending model?
So one of the things that's been very helpful for the lenders that we work with is to take their team and break it into 3 segments. The top tier, which are those that are most productive, at least 120% higher than average, company average of productivity. The middle tier is 80 to 120%, and the bottom tier is less than 80. And we break the bottom tier into 2 subsegments.
Okay.
50% to 80 and below 50%. So the stack there is pretty easy. Top tier, nurture the people, find more like them.
Yep.
Middle tier, coach that middle tier up so they can hit that top tier and improve productivity of the company. The bottom tier, minimum performance standards. You've got to do this amount of work to be here. And if not, you can't be here.
Right.
And it sounds harsh, but
but that's the reality. Paying 4 times, 5 times more, I think, is even harsher than making that tough decision with an individual that's just underperforming and maybe not capable of doing the job you need them to do.
And my colleagues have developed a way to do this with data. And it's really what we call a top tiering score, which is transparent, visible, and it gives the indicator of action. So it's transparency, easily visible, and indicates action. And that TVI score is computed almost like a FICO score. For an originator, it's on volume, it's on pull-through, it's on cures, concessions, and complexity of the loan. And for underwriters, it's on time to underwrite that they can control, volume and complexity. And it's a numerical score, and when we show it to our lending partners, they go, that's amazing, and they begin to look into it and go, you know what, it's true. When you take the compensation and put it next to the TVI score, you go, some of these people are costing us a lot of money.
Exactly.
Some are super efficient.
Right, and how do we, like you said, foster and nurture those that are doing it? Jim, you have a wealth of knowledge. You and I could sit here and talk for hours. I can't thank you enough for being a guest on this episode of the Fintech Hunting Podcast.
Michael, great to see you. Thank you so much.
Great to see you.